Silver just broke 60. You have seen it by now. The line that was supposed to be a wall cracked, and half the thumbnails on this platform screaming the same thing at you. 61 next, then higher, big red arrows, a man shouting a target. If you own silver right now, you felt that break somewhere in your chest, part relief, part fear, because you have watched this metal fake you out before. So here is the honest question, the one under the title, and I'm going to answer it with you. What is resistance, really? What actually happened at 60? And does a broken ceiling stay broken, or does it slam right back down on the people who bought the breakout? Here is what nobody flashing that 61 target will tell you. Resistance is not a law of physics printed on a chart. It is not a magic price where selling appears from nowhere. Resistance is a line somebody is defending, and a defended line in the metal markets holds for exactly as long as the person defending it has real metal to spend, and not one day longer. By the end of this, you will understand that mechanism cold, and you will be able to look at any breakout in any metal for the rest of your life and tell the difference between a ceiling that is genuinely gone and one that is a trap. And there is one signal that separates those two, the truly broken line from the one about to snap back. It is not on any chart. It is not the price, it is not the candle, it is not the target. I am saving it for the very end, because it is the exact thing the people selling you 61 will never put on the screen. And once you have it, you will never watch one of these breakouts the same way again. Stay with me, and it is yours. Because to understand what just happened at 60, you need to meet the last group of people who tried to defend a line in the metal markets, and you need to watch, in slow motion, what happened to them. This is not a metaphor I made up for a video. This is real. It happened. And a lot of you watching me were alive when it did. Go back with me to the late 1960s, to the gold market in London. For most of that decade, there was a number every serious person treated as bedrock, the way you and I treat the ground under our feet. Gold, $35 an ounce. Fixed. It had been fixed at 35 since before the Second World War, the anchor of the entire Western financial system, the still point the whole dollar was built on. And to keep it there, 8 of the richest nations on Earth had quietly formed something called the London Gold Pool. Their job was simple and secret. Whenever the free market price of gold tried to rise above 35, the pool would step in and sell real gold, physical bars, out of their own national vaults, enough to shove the price back down to the line. That was the defense. That was the resistance. 8 governments standing on a number, holding it down with the weight of their own metal. And I want you to sit at a desk on that gold market with one man, an ordinary dealer, a man who traded bullion for a living and went home to a family in the suburbs and worried about the same things you worry about. Every working morning, he watched the pool defend 35. Someone would push the price up, and like clockwork, the sell orders would come, the metal would flow out, and the number would settle right back on the line. To almost everyone watching, that looked like strength, a stable price, a wall that could not be moved. The financial pages called it stability. His own colleagues called it permanent. But this man was looking at a different number, not the price. He was watching how much gold it was costing them to hold the price there. And month after month, that number got bigger. The pushes came harder. The metal going out the door to defend the line came in larger and larger loads, because the whole world had started to figure out that the dollar was being printed faster than the gold behind it, and everyone wanted to trade their paper dollars for real metal at that bargain fixed price while they still could. He sat there and he thought, quietly, so quietly he did not even say it to the men beside him. This is not a wall. This is a dam, and I am watching the reservoir behind it drain, one bar at a time. A wall holds forever. A dam holds until the water is gone. He was right. In the spring of 1968, the run on the pool became a flood. The defenders were shipping gold out so fast they were flying it across the Atlantic by the plane load just to keep up. And it was not enough, because you cannot refill a national vault at the speed a panicked world can empty it. And then one day it simply ended. The 8 nations met, looked at what was left, and quit. They stopped defending the line. They shut the London gold market for 2 weeks. And when gold was finally set free to find its own price, $35, the number that had been bedrock for a generation, the wall nobody could move, was gone forever. Over the years that followed, gold ran from $35 to over $800 an ounce. The line did not weaken. It did not drift. It broke overnight because the metal behind it had run out, and a line defended by spending metal cannot survive the metal running out. Now hold that dealer at his desk, watching the reservoir drain. We are coming back to him, because his one number is the signal I promised you. First, let me show you why his story is sitting right on top of what just happened to silver at 60. Because 60 was a defended line too, not by 8 governments this time. The line in silver is defended by the paper market, and this is the part Wall Street would rather you never think about clearly, so let me make it plain. The price of silver you see quoted is not set in the world of mines and refineries and vaults. It is set in the futures market, a world of paper contracts, claims on silver, promises to deliver metal that in the overwhelming majority of cases never actually gets delivered. And in that paper world, someone can sell a claim on 1,000 ounces of silver in the time it takes you to blink, whether or not a single new ounce has come out of the ground. When silver tried to push through 60, that is what pressed it back down. A wave of paper selling, defending the line, exactly the way the pool defended 35, except the ammunition is not bars out of a vault, it is contracts conjured on a screen. And that raises the only question that has ever mattered in this entire story, the question the dealer at his desk was really asking. Behind all that paper defending the line, is there metal? Is the reservoir full, or is it draining? Because paper can shove a price around for a day, a week, a stretch of ugly sessions. But paper cannot create silver. And if the physical metal behind the paper is running short, then every defense of the line is a bar spent from a vault that cannot be refilled, and the line is not a wall. It is a dam. So look at the reservoir. Silver has run a structural deficit for 6 straight years now. 6 years where the world used more silver than it mined, every single year, and plugged the gap by pulling metal out of above-ground storage, hundreds of millions of ounces drawn down to cover the shortfall. China has been pulling record volumes of physical silver, imports surging well past its normal pace, drawing down inventories inside the country so hard that at the stress point silver in Shanghai traded at a steep premium to London, which is the market screaming that metal is being pulled toward the buyers faster than it can arrive. The deficit is real. The drain is real. And notice, none of it stopped when the paper price got shaken down into the mid-50s. The paper flushed. The metal kept leaving. The people who trade the claim panicked. The people who moved the actual bars did not so much as pause. That is the whole reason silver snapped back above 60 as fast as it fell. This is exactly the kind of moment where the decisions you make about your own money matter more than in years of ordinary markets. So let me stop and talk to you directly, because if you are the person this channel is really for, this next part is the entire game. If you are sitting on $100,000 or more in a retirement account, a 401k, an IRA, anything you spend a working life filling, then the difference between owning real metal and owning a paper promise on metal is not a technicality to you. It is the difference between the people who held gold through 1968 and the people who held a claim that somebody else could redefine. I put together a free retirement protection guide that walks through, in plain English, how some retirees are moving a portion of their savings into physical gold and silver without triggering taxes or penalties, held inside the tax-advantaged account they already have, real metal they own, not a number on somebody else's screen. If you are watching this on your TV, just scan the QR code on your screen. If you are on your phone or your computer, go to jeffreedguide.com. And if you go through it and want to talk it over, there is a free, no-obligation, one-on-one educational section for folks with $100,000 or more in any retirement account. No pressure, nothing to buy, just answers. All right, back to the line and what it means for you. Because here is where the 61 target comes in. And here is where I am going to be more honest with you than the thumbnails are. Yes, the people who trade this metal for a living are watching the next levels above 60. When a defended line finally cracks, the price often runs to the next spot where sellers try to make a stand, and there are analysts laying out where they think those levels sit. That is real. That is the case a lot of serious voices are making right now, that with the line at 60 broken and the physical market this tight, the path of least resistance points higher. But I am not going to stand here and promise you 61 or 65 or any number, because a target on a chart is a guess dressed up as a fact, and the second anyone hands you a precise price as a certainty, they have stopped being on your side. But here is the part that actually changes how you see every one of these breakouts, and almost nobody gets to it, so let me shift gears and make it sharp. There is a difference between a line breaking on sentiment and a line breaking on metal, and it is the difference between a trap and a turning point. A line that breaks on sentiment breaks because traders got excited. A few green days, a good headline, a burst of buying, and the price pops through the ceiling. But nothing underneath it changed. The vault is still full, the defenders still have ammunition, and the moment the excitement fades, the same paper selling comes right back, and the price falls straight back through the line it just broke, and everybody who bought the breakout on hope gets carried out. That is the trap. That is the fake out this metal is famous for. Silver has done it to hopeful buyers 100 times. A line that breaks on metal is a different animal entirely. That is the London Gold Pool. That is a line breaking not because traders got happy, but because the physical reservoir behind it ran dry, because the defenders finally could not deliver the metal to hold the price down anymore. When a line breaks on metal, it does not drift back. It does not give the shorts a second chance. It breaks the way 35 broke, and it does not come back, because the thing that was holding it there is simply gone. And the whole silver bull case, the reason a growing number of analysts are willing to put big numbers on the table, comes down to a single claim, that the line at 60 is closer to the second kind of break than the first, because the metal behind the paper is genuinely running short. Now, since we are talking targets, let me show you where the big numbers actually come from honestly, so you can judge them yourself instead of just flinching. A lot of it is the gold-silver ratio, which is simply how many ounces of silver it takes to buy 1 ounce of gold. That ratio climbed into the 70s during the shakeout because gold barely corrected while silver got hammered, and it has since eased into the high 60s as silver outran gold on the recovery, still historically stretched. And the math the bulls run is pure division. If gold merely holds where it sits now, back over 4,100 at a multi-week high, and if that ratio compresses back toward levels it has actually visited in history, silver's implied price is just gold divided by that smaller number. Back in 1980, at the last great silver peak, the ratio compressed all the way down to around 17. Run 4,000 something divided by 17, and you land in the neighborhood of a couple $150. That is where numbers like 250 come from, and near 40 to 1, you get the low three figures, the $100 zone, and the deep deficit cases run toward 300. Those are the numbers a growing number of analysts are quoting, and I am showing you the reasoning so you understand it is an argument, not a fantasy. But every one of those roads has a soft joint, and honesty means naming it. The ratio math assumes the ratio actually reverts, and a ratio can stay stretched for years and has done exactly that. And a few days of silver leading gold is not the reversion arriving. And I have to say the next part plainly, because you will run into it. There are voices out at the far edge calling for $1,000 silver or $50,000 gold, some clean 30-fold multiple. I am not going to insult you by pretending those come from the same place as the ratio math. They do not. Those numbers come from imagining a complete monetary reset, a dollar rebuilt from the ground up, and the bigger the number, the more it is assumptions stacked on assumptions. Treat the precision with real skepticism. I am laying out why those people argue what they argue, so you see the whole spectrum, not because anyone alive can hand you that number or a date. Which brings me back to the dealer at his desk, watching the reservoir drain, and to the signal I promised you at the top, the one that tells a true break from a trap. Here is the honest truth, and I need it to land, because it is the thing I cannot say often enough. I cannot promise you a price, and I cannot promise you a date, and neither can anyone else. And the moment someone does, close their video and do not come back. Silver is the most violent major metal there is. It overshoots wildly up and just as wildly down. You just watched it flush into the mid-50s and snap back above 60 in a matter of days. And it can turn around and do the ugly version just as fast. The line at 60 could break and then break the other way. It could round trip right back below where it just broke out from before any of this bull case plays out. The Fed under Kevin Warsh has turned hawkish, with a rate hike on the table instead of a cut, and metal that pays no interest struggles whenever rates threaten to climb. In the short run, silver answers to the Fed and the dollar and fear, not to the deficit. The shortage is the trend. The Fed is the weather. And the weather can soak you for a long time before the trend ever shows up on your doorstep. A few green days off the lows is not a confirmation of anything. So what is the signal? What was the dealer watching that nobody else was? It was not the price of gold. Everyone could see the price, and the price told them the wall was solid. He was watching the metal behind the price. He was watching the reservoir. And that is the one thing that separates a broken line that stays broken from one that snaps back on you. Do not watch the candle. Watch whether the physical metal is actually running out. The premium in Shanghai, the drain on inventories, the deficit stacking another year, the buyers who take delivery and never sell. When the paper price breaks a line and the physical market is tight underneath it, that is a damn giving way. When the paper price breaks a line and the vaults are full and the metal is loose, That is just traders getting excited, and it will fool you. The chart cannot tell you which one you are looking at. Only the metal can. That is the signal nobody flashing 61 will ever show you, because a drain on a distant vault does not fit on a thumbnail. But it is the only thing that has ever told the difference. So here is what to actually do with all of this, and it is not advice. It is just how a calm person thinks about their own position. First, and the pool taught this in blood, own the metal, not the promise. The people who held real gold through 1968 woke up richer. The people who held a paper claim held whatever the people who wrote the paper decided it was worth. A claim is not the metal. Second, size it so a violent drop cannot force your hand. Silver just proved it can flush into the mid-50s without warning. And if a move like that would force you to sell at the bottom to pay a bill, then your position is too big no matter how right the thesis is, because being forced to sell in the valley is how right people still lose. And third, never sell into the shakeout. The shakeout is the machine that transfers metal from the people who feel to the people who own. Do not be the fuel. If you are on your TV, the QR code is on your screen one more time. If you are on your phone or your computer, go to jeffreedguide.com. It costs you nothing to be informed, and the honest reason to look now is not fake urgency. It is the plain fact that the calm time to think a decision like this through is exactly when nothing feels like an emergency, which is right now, not the day everyone is panicking and the line is already gone. And for those of you who stayed with me all the way to the end, here is something just for you. If you have $100,000 or more in any retirement account and you mention that you watched this full video, you can claim a free one-on-one, no-obligation educational web conference, a real conversation about what you actually own versus what you only think you own. No pressure and nothing to buy. That is for the folks at that level who made it all the way here, and you are one of them. So could this video sit under some other title? No. You came to find out what happened at 60 and whether the break is real. And now you can answer it yourself. 60 was a defended line, and every defended line in the history of metal has held only as long as the metal behind it lasted. The paper can press the price down for a while. What it cannot do is refill a draining vault. Whether 60 stays broken is not written on any chart. It is written in the physical market, in the deficit and the drain. And that is the one place the people shouting targets never point. And that dealer at his desk in London, the one watching the reservoir instead of the price, when 35 finally broke, he was not surprised, and he was not ruined, because he had spent years watching the only number that mattered, while everyone around him stared at the wall and called it permanent. The wall broke overnight. The metal behind it had been leaving for years, one bar at a time, in plain sight for anyone who cared to look. That is the whole lesson. And it is the only sure thing in this entire video. Do not watch the wall. Watch the metal behind it, and own the kind nobody can redefine while you sleep.